Good morning, everyone. This is Mortgage Post 411. I'm Audrey Boissonou with my co-host Kevin Casey. And today we are joined by Mr. Bill Lowman. How are you today, Bill?
I'm good, thanks, and thanks for having me today.
Oh, we're always happy to have you. You know, it is nice to be in the green again with rates, isn't it? So I just wanted to take a moment of gratitude for our entire industry and point out that on April 25th, the 10-year was at 4.7, and today it is at 4.457. So we have had a fairly significant trek downward, and which is good for rates. So I'm really excited about that. How about you guys?
That's nice.
Always
Even with the
excited for
inflation
it.
numbers that came out,
What?
even with the inflation numbers that came out.
Okay, so clearly you did not read beyond the headline, Kevin Casey, because today's PPI report that came out, the Producer Price Index for the month of April, which by the way measures wholesale inflation, just in case you were wondering, it looked terrible because it looked like we were up 0.5 on both headline and core. However, they were expecting 3.3 tenths on headline and 2 tenths on headline. So if you just look at the whole, that you're like, holy crap, that's until you take a little dive. Right. But remember how we always preach, look beyond the headline, Kevin Casey? Yeah, you have to do that because they had huge revisions for last month. Last month's numbers were so funky. So funky. So anyway, bottom line was, again, it puts BLS in the crosshairs because as anyone who listens to me knows, I think that their numbers are so unreliable, and it's terrible that the markets move so dramatically based on their numbers. And here we are again, kids. So it is headline at 2.2% year over year, 2.4% for core year over year, which is basically unchanged. But the previous month's numbers were overstated by 3 tenths for both headline and core. Wow. Overstated. So those revisions.
3 tenths. That's 3% on the year.
Yeah. So the 3 tenths, if you take those revisions from last month and you put them, that's why these numbers today look so high. And so once the market started to digest it, that, my friends, is why we're in the green.
Nice. Woohoo.
So with that being said,
do you want more optimism, or do you want to go on the pessimistic side?
Let's keep going the optimism.
Yeah, we're good. Well, okay, I like a balance of let's get real, but let's, what do you think might be good?
Well, so, if we have stability in the financial markets, which that's a big if, but I think we are seeing more stability than we've seen previously. Typically mortgage spreads, difference between a 30-year fixed rate mortgage and the 10-year treasury, historically have been between 160 and 180 basis points, the spread between them. In the last year or so, that spread was at 300 basis points because the markets were pricing in the risk of volatility.
Right.
Now that's the mortgage spreads are about 260 basis points. So if you get, even without the benefit of market movement, if the spreads narrow based on stability, we could still see a little bit lower of 30-year fixed rate mortgage rates. So that's another optimistic view.
That's beautiful. And then tomorrow we have CPI, which is the consumer price index coming in. And what will be interesting is we'll be looking to see, are there going to be revisions there or not? And again, these numbers feed into the Fed's favorite measure, which will be May 31st, PCE, personal consumption expenditure. So there's a lot to look forward to. Meanwhile, it's the very end of May or beginning of June. I forget the exact date that the Fed is going to do a little less balance sheet runoff too. So, I mean, I don't know, kids, you know that I'm a real fan of just, what do we have in front of us? Let's go get a loan and close it. It doesn't matter what. But all this
That's way of doing it.
news. This is really what we want going into the spring and summer home buying season. So, yeah, I have a client who every time he does a refinance, and we have two and a half, I've got some seconds going on for him right now. Years ago, I must have made some comment about he's like, what do I need to do? I'm like, fall to your knees and pray for the bond market. So I explained to him why he needed to be an active participant in what was going on in the bond market. So he is currently in that process. He reminded me the other day, he goes, is it time for me to drop to my knees? I'm like, yes, it is. So with all that, we could get all of our people, and I don't care what you do. You can, involve Buddha, the spirit for the wind. I don't care. Just all of our energy towards things are going to get better. They are really.
So Bill, what was the bad news?
Oh yeah. What is the bad news, Bill?
Higher for longer. We're not going to
Oh.
see a Fed move.
We knew
one
that
at the
already.
most, but
Okay.
it's going to remain higher for longer. And
But think about this. All the Fed comments for the last month have been based on what? Flawed inflation numbers. Think about that. So it's going to be super interesting going forward to see if they change their narrative a little bit, right? And Jerome Powell, despite all that, he was still saying, we think we still have an appropriate course of action. And the next move will not be a hike, probably. He qualifies it, but it wasn't all doom and gloom. They were definitely trying to moderate all the enthusiasm, but I don't know. What do you think?
well, I saw you saying that when you say the flawed numbers, are you saying that they come off the 2% target?
Oh, never. They're not coming off the 2%.
Yeah, I was going to say that ain't happening.
Good God, no, flawed numbers. The huge revisions from last month to this month on PPI. I'm curious to see if that happens tomorrow with CPI, and then how that feeds into PCE. Those numbers. No, God, no, they're not. No. There
Those are
could
a lot
not
of those
be
are a lot of
anything
acronyms.
there.
Yes, there were.
You know what? Thank you for that little tee up, because that reminds me of another acronym. And I just want to thank you, Bill Lowman, for introducing me to this acronym yesterday so I could take a little dive in it. FSOC.
Yeah.
Reminds me a lot of VLIP and some of the other things that these geniuses have come up with recently. So, Bill.
What was the acronym now?
Jesus. FSOC. Can I jump in before you? Anyway, yeah, FSOC is the Financial Stability Oversight Council that reports to Treasury. It's part of the Department of Treasury. So they came out with a report released on Friday, and essentially, because 7 of the top 10 mortgage servicers are non-banks, because about 55% of the outstanding mortgage loans are serviced by non-banks, Treasury Secretary Yellen feels that that poses risk and vulnerability in the financial system. And if these non-banks, if you stress test them, that their liquidity they wouldn't have enough liquidity to continue to perform the servicing obligations that they have, and it would create disruption. So FSOC is recommending that Congress give FHFA and Ginnie additional oversight authority on non-banks, which is all of us independent mortgage banks. And while the release relates primarily to servicing, it would extend this oversight to all areas of an independent mortgage bank's operation. So look, there's this perception that non-banks are not regulated. I feel we are highly or overly regulated when you look at all the counterparties that we have, every state that we operate in, CFPB, FHFA, Fannie and Freddie perform audits on all independent mortgage banks. Every warehouse lender provides or performs audits. We are scrutinized to the nth degree. And I think this would simply put more cost and complexity into this. And ultimately, when cost and complexity occurs, the consumer is the one that is primarily harmed.
The bag again. I know, I agree. So there were some points that were made that I thought were really interesting. So the report also acknowledged that non-banks are key for underserved groups, and then went on to say, but are vulnerable to economic shocks. Thank you to Housing Wire. But they also said, this was interesting, I thought. In 2022, they originated nearly 2/3 of mortgages. IMBs originated nearly 2/3 of mortgages.
Yeah.
Did you get that? That's amazing. Compared to 38% in 2008. They own the servicing rights on 54% of mortgage balances in 2022, up from 4% in 2008. And then, yeah, to your point, 7 out of 10 servicers. So they were definitely focused on servicers, but but again, who thinks we need more oversight? The last thing we need is another regulator, for God's sake.
For sure.
And the point was made by your friend, Bob, I can never say his last name correctly, Brookschmidt.
Brooksmith, yeah.
Okay. He's the president and CEO of Mortgage Bankers Association, that he said that some of these recommendations are unnecessary, as layering duplicate supervision requirements or supervisory entities on a heavily regulated market will add significant costs and complexity. And again, it's just like, we are, good God. Anyway, so.
Can I offer an opinion on this?
Oh my God, please.
So here's what is happening, I think, and motivating this, and we're seeing it in other areas. So this is election year. And I think that look, forget about where you land politically. I think there's a likelihood, perhaps maybe even a better than average likelihood, that we're going to have a change in administration this year. And if in fact that happens, you are going to see, like you're seeing with the CFPB, coming out with all sorts of stuff on fees and regulating fees and everything else, because they're trying to get in their agenda if there's an administration change. This is what I think is happening with this being pushed out by the Treasury Secretary. And by the way, is this unique? No. Think back to 2020, when it appeared there was a likelihood that there was going to be an administration change. And this is when we were going through all the stuff that gave us angst with Director Calabria of the FHFA, imposing fees on refinances, trying to accelerate taking Fannie and Freddie out of conservatorship. And he was trying to jam his agenda in before the administration changed over. So happened in 2020, it's happening in 2024, and it's just over politicizing housing in the mortgage markets, and I think that's dreadful.
It is. And again, just want to really drive home the point. This is both sides that do this. It is not one or the other.
No, it's not. It's happening in
both
2020 with, when it appered Trump was out, happening in 2024, when it appears there's a chance anyway that Biden's out. Who knows, right? But this is what's happening.
Yeah, it's not good. Okay, so Bill is very excited about something, and I'm going to tee it up for him because I wasn't quite as excited, but I'm trying to get excited. So here we go. So,
but there wasn't wasn't the FSOC?
No, well, the FSOC is interesting again, because we are talking about increasing the cost to the consumer, which none of these people think about twice. They just think, oh, we're going to create this other agency. We're going to regulate more. We're going to do this, this, and this. There's no thought for the ROI, right? What are you really?
They don't know what that is.
That's probably true.
They just know you get a pay stub when you show up to work.
That's right. They go to work, they get paid. Boom, done. That's not what the rest of the, like the fact that all of these regulations trickle down and the consumer pays, and there should be some analysis of how it's going to benefit everyone before you spend money. So yeah, anyway. So we have a big problem with our poor little consumers who are up to their eyeballs in debt. So they are using all sorts of things like, credit cards, and buy now, pay later. 43% of buy now, pay later, they're now delinquent. The consumer sentiment.
What number? 43?
43% of the people using buy now, pay later, which by the way, don't report to the credit bureaus. They're behind on their payment. 33% turned to the services after maxing out their credit cards. 54% said they bought more than they could afford. 24% said their buy now, pay later spending was, and I quote, out of control. 42% of those with household incomes of more than $100,000 report being behind or delinquent on buy now, pay later payments. I mean, are you getting this, guys? This is crazy. 50,
Amazon's really big on the buy now, pay later thing.
50% are already or considering using it to pay bills or buy essential items, including groceries. So Bank of America came out, and by the way, I just want to credit MBS Highway with these stats, because that's where I got these, and they're really incredible. So B of A came out with their report, and 8.5% of Bank of America's customers, 69 billion people, had a buy now, pay later transaction in March. 50% were lower income consumers, heavy users. They consider a heavy user is somebody who's doing it 20 times in a month. 20 times. Okay. And that almost 10% of B of A's customers used it at least one time in March. That is crazy, but that means 345,000 people used it 20 times in a month. Now, I just want to take a little traipse into the facts. When you're doing buy now, pay later, you are not being charged interest. They don't do a credit report, but you have, I don't know how they figure it out, but there's some sort of payment system. And so it's automatically going to hit your credit card, your bank account, I don't know what, for the payment on a projected later date, right? And it's a very accelerated repayment period. So It's not like you're paying over the next 10 years or 20 years. It's like you owe, whatever you just charged in the next, I don't know, let's call it 2 months or whatever. So with that being said, again, the consumer is in trouble and needs cash, which means we did a whole thing on cash out refinance seconds last week. And Freddie Mac has proposed a new second program. Bill, tell us why you're excited about this.
Well, for some of the reasons that you just said, because I think there's a lot of underlying delinquency and credit challenges that are going on that could ultimately percolate. So look, and I understand that this is or can be a bit of a polarizing matter when it comes to the agencies doing seconds. They got out of them, at the time of the crisis. I think there's debate on whether this is part of their charter or not, and I get all that. I will tell you, as a lender, why I like it. I feel like that anytime lenders like, American Pacific Mortgage and any other lenders that are funding their own loans are on the call, your ability to, the liquidity provided by the agencies is solid and is not going anywhere because it's backed by the full faith of the federal government in any circumstances. And I think some of us that had some challenges back in 2020 when we hit a volatile market and there were non-agency loans that we couldn't fund. And I think this gives lenders confidence in delivering a product in high scale. And so that's why you'll see, that's why I am at least initially supportive. I was a part of a call with Freddie last week where they laid out some of the guidelines. I think, I can go over that briefly, and I think it's been in the industry press as well. So I don't think there's any.
No, go ahead. Just lay it out. It's not long. Share it with them.
So it's going to be fully amortized, 20-year, 80% max LTV. It will only go behind a Freddie first. And this makes any of the loss mitigation and servicing, much cleaner in doing a second mortgage product. Initially, because while they haven't given a rollout date, because Freddie does want to get this rolled out, they are going to roll it out as a manual underwrite only at first while they update their LP to do an automated underwrite. So initially it's going to be a manual underwrite. The loan amounts, the combined loan amounts cannot exceed the agency limits in your area. So that's, that'll dictate what the loan amount is. They are in the discovery phase on pricing. So there's no pricing indication. That was the first question a lot of people had.
And then by limits, are you saying the standard conforming limits or high balance? Also?
High balance limits. is
Nice.
what they're saying initially.
Cool.
In the high balance areas, there are some areas of the country, I know we have people all over the country on this call,
Right.
don't even have a high balance.
Right.
High
There's other
balance
parts
limit.
like Alaska and Hawaii, everything's high balance, so.
It's, they're not gonna pilot it. It's going to be a broad rollout, initially.
So
What'd you say was the
just-
maximum CLTV?
Just
80.
Just to let people know, a lot of times when they roll out new programs, they test them with a few different lenders.
Yeah.
So when he says pilot, he's just saying that it's not going to be that way. They're just going to roll it out to
That's
everyone.
right.
Just see what happens.
That's right. And so, you know, the consumers that are not willing to, and I don't blame them, get out of their 3% mortgage, but have built up equity and are incurring high interest rate debt. This is an option, a tool for loan officers and lenders to offer them relief. And, you know, we'll be smaller loans, but we'll take anything we can get right now, right?
Well, it's,
And they'll get, go ahead.
no, you go ahead.
I was gonna say, and the loan officer will get paid on it.
Yeah.
Nice.
Of course.
Not just
I
like
mean-
$500, but like, you know, bips.
Well, you know, depends. I guess it depends on the loan amount.
Yeah.
Well, so it depends. So I've closed one HELOC this year, and it was a $50,000 HELOC, and my processor complained all the way through the process, saying, "Why are we doing this? It's so much work. What's the point?" And I'm like, "It's relationships. It's
Yeah.
relationships. I'm doing it because I have a relationship with the borrower, and they are important to me for a myriad of reasons. It's relationships." So when it funded, he sent me a picture of the front of a dollar store and told me, "Enjoy spending your commission because that's the only place you can buy anything with it." And I said, relationships, relationships. So with that being said, it is a way to maintain those relationships. And I saw a poll on LinkedIn a couple of weeks ago where someone was saying, all right, if you're an LO, you know, what is the likelihood that you would do a HELOC or a second? And it was resoundingly like we would, right? But
Yeah.
if you would ask the same group of people, all of us 2 years ago would have said, not a chance, no way, not going to happen. And I still send my borrowers to their bank first to see, can you get a better deal? And, but you know, they can't. So here you go. All right. So the thing, and it's funny because there's a comment here from Mark, who says, how many buy now, pay laters are homeowners, which is a great question. I don't know the answer to it, but if their incomes are over $100,000 and they're a big chunk of it, and then there are homeowners doing this too. But Mark is does the shared equity programs that we've talked about a few times on here in recent history. And so one of the things that I'm interested in with Freddie's guideline rollout will be, how is the qualification going to go? Are they going to have to go through it? I mean, if it's a manual underwrite, one's going to assume they're going to want to see everything just like usual. It's not going to be some modified or streamlined qualification process. They weren't talking about that, were they, or were they?
No, they weren't, although what they did say, Audrey, was it is TBD on what they would do for collateral valuation. So, you know, would you use alternatives, ABM, whatever, and they said TBD.
So we don't know.
Just keep in mind, you're going behind there first, so you know,
Right.
you have a pretty good clue of what the value is already.
You
Yeah.
do, and they have so many models that they're able to
Yeah.
run on the
Yep.
data that they have. They're probably running some internal thing anyway. So what is the rollout date on this thing, Bill?
TBD. They have to get, this is a comment phase right now. It's something new that has been imposed upon FHFA. The FHFA has imposed upon the agencies where new products need to go out to a comment period, which part of the call that I was a part of was part of them fulfilling their comment period obligation.
So I made a
And
lot
then
of comments.
ultimately FHFA decides, you know, yay or nay. And I expect that
They don't want to do like Cal Haffa and roll out a program and have it all run out of money in 3 days.
It was
Yeah,
11
I'm not
days,
worried
Kevin,
about that.
11 days.
Oh, 11 days. I'm
Yeah,
sorry.
I made a lot of comments to you yesterday, Bill. Are you going to share those with them?
No. No.
God. Oh my goodness. Okay. So I saw a little blip that I thought was interesting. It came from Housing Wire, and Fannie Mae, we know that they've been scanning our appraisal reports, right? But I didn't understand to the extent that they were scanning our appraisal reports. So they do a scan that is looking for prohibited or subjective language in the appraisal,
Yes.
right?
Oh, yeah.
Okay, so they are so the same. So subjective language as the use of unsupported assumptions, interjections of personal opinion or perceptions. Their stated goal is to help lenders and appraisers stay safe as it concerns to their obligation to comply with fair lending laws and with the uniform standards of professional appraisal practice. They said it's really works. So listen to this. So they started this in 2021. Fannie Mae started scanning for saying, and then they sent letters to 1,500
To the
appraisals,
appraisers, yeah.
got called out. You know
Mhm.
what? You act like you know this. Do you know this,
I
Kevin?
do, because
Are you just being supportive? Okay. So to alert them of violations similar to instances of potential bias found in the FHFA that year. So 79% of appraisers who received the letter in 2021 had no new findings in 2022. So they cleaned up their act. Fannie said that in 2023, the fractions with no new findings increased to 93%. And then 91% of appraisers who received a letter in 2022 had no new findings in 2023. So overall, there is a fraction of appraisals that have this kind of language. The occurrence rate in stood at 0.15% in 2021, and by 2023 is 0.03%. So these were not big numbers. That's good. The good news, in my opinion, of all the appraisers in the country, I don't know how many there are, but if we had 0.15% of appraisals that were an issue, potentially, I mean, I find that, I don't know, heartening. Yeah.
I agree.
It wasn't, there was this huge hoopla about these biased appraisals and how terrible everything was. And maybe it was isolated incidents where, when you call someone out and say, hey, although I did have a picture of a bunch of crotchety older people
well, I just
who
told
had been doing
visualize.
appraisals for 50 years,
Yeah, that's
trying to
exactly what I was gonna say. I've been doing appraisals for 30 years. It's like, shoot.
40, 50. I think that we have some 50s in there. Anyway, bottom line is they're working on this and it seems like it's going in the right direction, which is great. Yeah.
Yeah.
Okay. I saw a very funny thing today from Michael Fisher on a Facebook chat group. It said, marry the house, send the rate to counseling.
I was like, that's a new one.
I know. Yeah. Oh, really? You thought I was going to come in with some stale material?
Yeah, I did.
You
Just
were
for a minute.
hoping. You were hoping. All right. What else
And
do
so
we?
that means you're a rate counselor.
Yeah, exactly. Well, well, we are. I am a rate counselor. Forget the rate. Can you afford it? Is it going to cash flow? That's my counseling. So they keep lowering the growth projections for, is it NBA Bill that keeps doing that? Or it's all of them, but
It's all that and Fannie have. And I presume Freddie, I pay attention primarily to Fannie's and NBA. And
at
they
least,
lowered them by about 11%.
speaking of Fannie, that I meant to ask you this when we were talking about second. So Freddie is talking about rolling this out. Do we expect Fannie to do it? And are we gonna have rioting in the streets of the people who have Fannie Mae as their original source, and now they don't get a second through the GSEs? I mean, how unfair is that? And by
Yeah,
the way,
and imagine the consumer confusion,
oh
which
my
we
God,
do enough to confuse our consumers.
yes, we do.
Consumers don't know whether the secondary outlet was Fannie or Freddie. They know who's servicing the loan and who they're making their payments to. And if that's crazy. So coming up next week is the Mortgage Bankers Association Secondary Market Conference in New York.
Okay.
And those of us who attend, we have our meetings with Fannie, Freddie, all of our counterparties. That's like first and foremost on my list to talk to Fannie about. And also we've got a meeting with Sandra Thompson. And if she's, kind of the master, the Wizard of Oz when it comes to new products and having it going through FHFA. It's like, don't do this to consumers. Like,
Yeah,
let's not play this game. Oh, they did it first. Let's wait and see how it goes. That's not good. So I'll let you know the answer that I find on that.
great. And then I also was on Bill yesterday about what are the trade organizations like NBA and some of the others doing about maybe increasing the capital gains, and he has promised he's going to mention that next week. But
Yeah.
then did you see the article I sent you this morning?
I just saw that you sent it, but I didn't read it.
Yeah, so this is an idea. This was so National Mortgage Professional actually wrote about this too, and I thought this was really interesting. So brace yourself. If you hate all the numbers, just zone out for a minute, you'll be fine. So the homeowners exemption hasn't changed since 1997. It's 500,000, as we know, for a couple and 250 for someone who's single. So CoreLogic was saying that in the peak year of 2022, more than 300,000 homes had gross capital gains above the $500,000 limit, which is a 140% increase from pre-pandemic levels. And, as we are talking about ways to get people to be more incentivized to move, the talk about capital gains needs to get louder. And Kevin and I have been talking about it for a while, and it is definitely out there, and it's something that would be a motivator for someone. And I was walking Bill through my client who just sold their place, and their capital gains after the exemption is almost $400,000. So if you have that's on a $2.5 million sale. So, and that's with somebody who kept amazing records and built an ADU, had tons of expenses, and he was able to back all that out and still $400,000. And so the point is, the average consumer can't afford to give $400,000 of their very, limited amount of wealth they may create in their lifetime away. So one of the way, and the other thing we talked about was maybe you do it in tiers, like maybe you get more of an incentive if you're willing to sell your house to a first-time home buyer or a veteran or a whatever. But I think that if the numbers were created in 1997, which was, I don't know, a while ago, it's time for a look at that. And they're going to go, well, where's the money going to come from? But the bottom line is, if you really want to help people,
you want to move some
need
houses
to.
off the market and into people's houses, and you want you got to get that transactions going. That's going to generate a lot of income just from that.
Yeah, every time somebody moves, it costs, they spend $1 zillion.
I was talking to a contractor yesterday. He's like, oh my God, it's dying right now because there's no one's buying houses right now.
Oh, that's interesting.
Yeah.
Yeah. So anyway, I think it's worth the conversation. Bill, you'll
Will
do. Yeah. All right.
Yep.
Anything else you want Bill to talk to NBA about? Put it in the chat. Let's light it up, shall we?
Yeah. What about is FHA going to be doing a second loan program also?
FHA,
No.
behind their 97 point. Yeah, probably. Oh my goodness. Okay, so walk us through the latest you've heard on the FAIR plan. And guys, if you're in some other state, I apologize, but if you're licensed in California, listen up. So we have the California FAIR plan here, and
there's a couple other states that maybe want to listen to anyway, because they'll probably be copying the plans.
So Bill, Bill has some info.
Other states have similar issues, although other states don't have the specific issues that California has with the FAIR plan. So in consideration of your multi-state audience, I'll try to be quick here, Audrey and Kevin, but so as you probably know, the FAIR plan is basic fire insurance for high-risk properties when you can't get insurance that traditional companies provide. So It's not meant to be something you shop to. It's meant to be a backstop when you can't get it. So the concern right now is the FAIR plan is a bad summer or a bad year from being insolvent. If there is, a lot of fires, which, those of us in California, we brace for that. And if it is a bad year, and there's a lot of claims, there is a high risk that the FAIR plan would become insolvent. If the FAIR plan becomes insolvent, the claims will get paid, but essentially the insurers, the other insurers in the state of California must backfill the deficit at the rate of their market share in California. So if there's a, $1 million deficit, and State Farm has 25% of the market, I'm just pulling numbers out of my head.
Right.
Then
And
they would be required to pay $250,000 to prop up and stand up the FAIR plan. And
That's
it's
why it
like
was
creating
going out.
this perverse financial incentive for insurance companies to leave.
Yeah.
Not an easy issue to solve. The
Mhm.
Department of Insurance is kind of like, the Attorney General's office. It was set up in order to have independence from, the governor's office. The governor can push down executive orders and things like that. But what is being pushed onto the FAIR or the Department of Insurance is, one, California uses antiquated modeling for modeling out the risk areas. And they use a one size fit all. And most other states have a more dynamic, forward looking modeling program. So California is looking back 20 years. Other states are looking forward at, and that could go both ways. What's the impact of climate change? But what is the impact of improvements made to housing and infrastructure to withstand these certain areas? So there's a couple of regulations that are being pushed at the Department of Insurance around the modeling, which I just described, and also to allow insurance companies to offload their risk by setting off, reinsurance, by doing some reinsurance on their secondary market where they're pushing the risk onto other buyers. So that's what, is part of the many different aspects that, need to be considered to provide a solution here.
And kids, that was the short version.
Yeah, that's
Yeah, you know what? I know, and I
It's
apologize for that, but
complicated.
it's like, shoot.
Yeah.
well,
Yeah, it's
yeah.
complicated.
I'll share my own personal story. So I
Make
lost
it
my
quick,
insurance.
Casey.
Yeah.
Make it quick.
Yeah, well, I lost my own personal insurance. We've talked about this before. So I'm on the FAIR plan, $6,400 a year, plus I have to get my additional insurance on top of that, plus the flood insurance that'll never flood, but okay, I have to pay that. So it's like 10 grand all total for my home insurance, which is just absolutely crazy. I was paying, I thought it was crazy. I was paying 3 grand before. So I've been calling around a couple different, I have a broker that's got this all done, but I've started to call from some of the independent insurance companies and see if they would insure my house. Someone told me AAA would do it. So I called AAA. And then they said, well, how old is your roof? And I said, well, my roof is 28 years old. And they're like, well, we can't insure you because your roof is more than 25 years old. But I go, I have 40-year shingles on the roof. Why would I need to replace them after 28 years? So I thought, well, wait a minute. I'll go get a new roof. That'll save me, $7,000 a year. I can cover that pretty quick, right? Oh no. The bid I got to have a new roof, $63,000.
68,000.
I know it's 63. I just looked.
Oh, you told me 68.
Yeah.
That's crazy. That in and of itself is nuts. But again, you should feel good. You pay 10 grand a year for your house, which is worth way more than the $260,000 house in Louisiana that my friend told me.
Yes.
And their insurance was
That's
10
insane.
10 grand a year for a $268,000 house. That is nutsola. So, okay. So insurance is an ongoing issue. Yes, we know. And, okay. So trigger leads. Let's talk about that, Bill. It's inching its way forward, sort of. Is it going to get through Congress and get into some sort of legislation before, it expires again?
Pointed question. Yeah, I think so, but so look, initially and still, the trigger lead bill has bipartisan support. This was a big part of what many of us were doing when we went to advocacy
Yep.
week in DC back in, I think it was end of March or April. Right now, and I don't want to use DC bullshit terms, but the bill
That
is
was
in
that was a
markup, which
DC term.
means it's waiting to, or it's the bill sponsors are trying to get it attached to legislation that goes to all of Congress and attaching it to something, that's going to be a Senate banking bill or a House Financial Services Committee bill.
The funding Ukraine bill.
Sounds easy, right? Like stick it in there and let's get it done. The challenge with this is where Washington DC dysfunction creates issues with my bill's in, your bill's not in. Well, we're not going to put that in this one. We should put it in, and it's just it's caught up right now, and the shit doesn't get done in DC anymore.
No.
Do I think with the help of lobbying firms like the NBA and others that have broadly supported this to get it done? Yeah, I think it'll happen. It shouldn't be this hard. I
Can
guess
we do another call to action, Bill, where all of us weigh in, get our clients to weigh in, do a link so that we can all notify our Congress people? I mean, the garbage guy, whomever, everyone has a stake in this. It impacts all of us. So
Yeah.
how about another call to action? It's been a while. I think it's a good idea to get everyone involved. So
God, I got a lot of homework. I got a call to action.
Yeah.
Now I got to write this down. I got a call to action. What else? What were my other assignments?
You're supposed to talk about the raising the cap gains exemption, please. We had a few different ideas on what that should look like. We're open. We just want something.
On what? And what was the third one?
I don't know. We haven't come up with it yet, I don't think.
No, we did.
Oh, we did. Okay, if somebody remembers, put it in the chat.
Yeah.
We have a comment here from
Talk to FHFA about Fannie doing seconds.
Fannie seconds. Yeah. And somebody asked what the minimum loan amount is on these Freddie seconds, and the answer is we don't know. We don't know much.
Well, it's going to be the combined loan amount can't exceed the agency loan amounts.
They want to know what the minimum loan amount on the second.
Oh, the minimum. I don't know.
Yeah. So comment here from Jenny, just got a non-fair plan policy and had a standard all perils deductible of $5,000 and a separate wildfire deductible of $35,700. I mean, are lenders going to accept that as a deductible? Like, what do what did the investors say about percentage wise? Is that okay? Holy moly.
Well, I don't know guidelines that well. That would be a red flag for sure, huh?
Yeah, usually 10 grand is your max usually, at least in California.
So they're saying that of course, Fannie allows 1% of the insured value. Value.
Oh.
All right. I guess.
Okay.
Oy vey.
Thank you for that.
Yeah, thank you. But holy moly.
That got a $3.5 million property there.
How is the average homeowner can't swing that. That's the thing. I mean, it really feeds right into the whole condo conversation we've been having lately with the HOAs, et cetera, which is fascinating. Okay, so I want to take a tiny little dive just for a second because I have a story that will feed right into this. You mentioned, Bill, that there is a bill, there's too many bills floating around here, that California is considering having an AI consent.
Oh, yeah.
Can you just tell us briefly about that, please?
There is a bill being proposed in the California legislature that would require consumer consent for any time AI is used. So if you didn't offer your consent, then I would, you would couldn't run DU or LP
without their consent.
And you probably then have to be turned down for your loan because you can't get manually underwritten.
Unless you're getting a second from Freddie, that is.
Right. And so there are provisions that, you know, if the AI provider has to, you know, essentially provide a look into their black box, and do it like annually. I can't imagine Fannie or Freddie opening their black box to anybody. And they certainly can't ask lenders like us, because I don't have the black box to DU and LP. So this one's being fought pretty vigorously, because again, if this is going to, you know, prohibit borrowers, you know, I mean, and if they're not sophisticated borrowers, you know, I would say no. I don't want anybody using AI on me, like, you know, and they could opt out, and they don't know that that they may not qualify for the loan. B, lenders are then potentially going to have to have more underwriting staff to manually underwrite loans in California. That's going to jam up or deteriorate the servicing values in California, which makes pricing shittier in California. And California is 25% of the mortgage market, and we've now just regulated our consumers into a corner.
Well, and what California does, then the rest usually follow. So it would just be the first
that's true
drop. So there's that. And by the way, I was going to say, we've had a couple comments that Fannie, Freddie, everyone allows 5% of the dwelling coverage for the max deductible. But again, 5%, I don't know, $35,000, $40,000 deductible just seems like it's going to be tricky for a lot of people. When, you know, usually we see $2,500 or $5,000 or something like that, but 40. Anyway, so back to the AI thing. I think it's interesting. First of all, you know that what's going to happen is they're going to bury it into the electronic disclosure acknowledgement, and no one will ever read another. Nobody reads the disclosures. It's my big gripe. I love the ability for someone to electronically sign because it speeds it up, right? I hate the ability. I hate the ability to electronically sign because nobody reads a single thing anymore. It's so I used to, I'll skip the I used to, but you know, it's not great necessarily that we're clicking away and the borrowers don't know what the hell they're signing. But anyway, yeah. Okay. So
I have a great notary on the backside. So when they're finding their final papers, she actually walks the clients through all the paperwork, explains everything they're signing.
I go to my signings, and
I know you go to your signings.
If they'll let me. Yeah, I love doing that. Just
for those of us who still don't go to our signings.
You don't have to read the whole thing. You just have to say, and this is where you are telling them
that's what she does. She literally walks them through and explains, okay, this is what you're signing. This is what you're signing. This is what you're signing.
Okay, so I have been dying to say this for a week and tell everyone this story because I found it fascinating as we were talking about AI, and everyone's so in love with tech and it's going to solve all the world's problems and everything is groovy. Okay, so there was a company that issued credit. I can't remember exactly. I definitely wouldn't say which one, but anyway, so they figured out through all of their analysis, and there's so many different ways to describe that at this point. I know I have a kid who is deep into this AI stuff, and I listen to him very intently so I can learn, but boy, it's very multifaceted. So they established that customers, and they are looking at your credit card bills, kids. They are looking to see what you're buying, what time of day you're buying it, where you're buying it, what it is. They determined that people who buy fast food chicken on Tuesdays between 2 and 5 p.m. have a 30% greater default probability on consumer loans and credit cards. I did not make that up. That is a thing. Did you get that? You buy chicken at a fast food place between 2 and 5 p.m. on a Tuesday, and the probability that you're going to default is 30% higher than the other person. How do you explain that to somebody? Okay, we got all these fair lending laws. We've got all these different rules around how we are supposed to treat everyone. And now you're going to be judged on your chicken purchases? Are you freaking kidding me? I was blown away by that. What do you think about that, Bill?
I think I don't want anybody and all my friends on this call to hang up and go to Chick-fil-A because it is Tuesday and it's going to be 2:00 on the East Coast. So
is that, I mean, but this is what they're drilling down to. Like I don't even understand how that becomes part of the conversation, but I mean, is that gonna be an acceptable reason on the denial letter for not getting credit? And I
Chicken
understand they
choices. It depends
probably,
what chicken choice. Now, do they take the crunchy or the traditional?
I know. I know they have a lot of different, my son and I were talking about this, it's not just one thing. That's not the reason. The reason is, maybe they have 70 different uh pieces of data that they're looking at. But the fact that that's one of them is remarkable, remarkable. And it harkens Kevin and I back to, and we've talked about this on here before, the company that was using AI for everything. And someone figured out that they were denying all the plumbers. And at some point in some process, the system had learned that plumbers were a bad risk because some plumber defaulted. And so, I mean, we got to really, really watch the computers and what the systems are doing, and don't just take it as, oh, if it came from the computer, it's better, for goodness sake. Yeah. So,
Okay.
oh, somebody made the comment, if they're buying at those odd hours, they're probably unemployed. And I bet you the system, I think he's right about some part of that, because
I
okay,
bet that is, yeah.
if you're online buying a bunch of crap, doing buy now, pay later, or buying things at 3 o'clock in the morning, and the system is like, wait a minute, why aren't they
Oh,
asleep?
that was 2 a.m. to 5 a.m. I thought it was 2
Oh,
p.m. to
no, no,
5
no, no.
p.m.
It was PM, but we're talking about
Oh,
other things. I mean, they're
oh,
looking at our credit card purchases. So I'm like, all right, I'm paying cash for everything going forward, for God's sake.
If
Like,
you're buying chicken at 2 a.m., I think you have a
I don't think you can.
other issue.
I don't think anything's open, but regardless, the point is they're mining our data to come up with
that's
this kind of
crazy.
information, and I find that shocking, personally. Personally. So
Uh-oh. To find out about my boba habit.
do you use a credit card to pay for that?
It's put on my debit card.
So you do. They're looking at your purchases.
Yeah, I need to stop
Yeah.
using my debit card. That's what I have to do.
Cash. You have to use cash.
Yeah,
It's
all
crazy.
cash.
As less and less of our life becomes, private. I mean, who saw that? So anyway, Bill, anything on your credit card that you wouldn't want anyone to see? Like
Lots.
chicken purchases at 2 o'clock in the afternoon? Okay, so from our friend Dr. Elliot Eisenberg, recent research shows that for every percentage point that mortgage market rates exceed the rate currently enjoyed by the homeowner, so let's say they have 5%, now the rates are 6%, the probability of sale is reduced by 18.1%. This led to a 57% reduction in home sales with fixed rate mortgages in Q4 23, and a reduction of 1.33 million sales between Q2 of 2022 and Q4 of 2023. The supply reduction boosted home sales 5.7%, outweighing the impact of higher rates, which reduced prices by 3.3%. I think this is fascinating that people break this down this way, but I think that's interesting that, if you're a point over what the rate you currently have, the probability that you're going to do some sort of sell your house or do a loan is reduced by 18.1%. So, when you go from, 2.5% to 8, it would explain 2023, right? Or 2022 and 3.
Yeah.
Yeah. So
I was going to throw out the idea to Bill, the one I had about the fact that all these people that refinance from, their 5% rates into the rates under 3%, that maybe they should lose their income tax deduction, because they already got their income tax deduction by lowering the rate so much that they're probably saving more money than they would have if they hadn't lowered their rate. And then maybe increase the future tax deduction for people that are borrowing at these current higher rates. That's offset the, because the government's always looking at how to fund this thing, but increase the deduction for borrowing at these current higher rates. And that would encourage more home transactions.
I
Capital gains adjustment.
You might not get broad consumer support for that.
You think?
Well, if you think Trump is going to come back, you might be willing to open an idea for that one, because he's the one who dropped the rate in the first place to set the cap at 7.5% or $750,000, right? No.
Marry the house, go to counseling, Kevin, or whatever the saying is.
Actually, honestly, if you just change it, increase the tax deduction for the interest for the increasing the limits on new purchases, that would encourage more people to buy it, because now that that 7% interest rate is not such a big deal because it's more of a deductible, and therefore maybe you'd see more movement. I don't
Or
know.
like my clients who just closed on the first leg of their journey towards getting rid of their 2 5/8 on their primary and their rental property, because their situation is not serving them anymore. They do not want to live in they had moved out of their primary into their rental property, and they just sold the primary, the original primary, but the rental property doesn't cut it. They wanted the proceeds from both so they could buy the house that they're going to be comfortable in. How much, I mean,
We need to
5 million
find more
dollars in
people like that.
properties.
That's what we have to do.
What?
Find more people. We have to find more people like that.
I know. And again, I've had so many conversations with him, and not once have we talked about rate. We talk about payment.
Mhm.
Payment. Can you afford this? If we do it this way, can you afford this? Okay. Just leaving you on a note that will hopefully encourage you to go find loans to help your consumers. The consumer sentiment for May came in, and it was not great. So they expected to have a drop of 1 point. It dropped by 8 points. Weakest in 6 months. Consumers are not feeling confident. They think that inflation may edge down slightly, but they think that unemployment isn't as strong. They don't feel good about finding new jobs. Their income expectations are lower. They're spending, they don't plan to go spend money. Like, the consumer is not, despite all the numbers showing that the economy is fantastic, the consumer doesn't feel great. So go show them possibilities of how you can help them with a cash out refinance. If they buy something and take the part of the equity, pay off all their debt, and then buy their new house, is that going to improve their situation? You know what I mean? Give them options, whether it's a second, whether it's a new purchase and consolidate debt. Think outside of the box, kids. We're here to earn our keep and show why we're so much better than pushing a button when you're, binge shopping in the middle of the night and think, oh, I'll just get a mortgage too. All terrible ideas. And so there's a lot for us to do. The rates are doing a little bit better, and we're going to have a great week, right?
Sounds good to me.
All right.
Good seeing you, Bill.
I will talk to you later. Have a good one. Thank you.
Thanks, everybody.